Hello and welcome to today's session of Indian economy, that is chapter 5, foreign trade. In this chapter, we shall study about trade, importance of foreign trade, India's foreign trade at the time of independence and after independence, inward-looking trade strategy, impact of inward-looking trade strategy. First, meaning of international trade. Domestic production of certain goods may exceed their domestic consumption. Those surplus output is exported to other countries in order to earn money. Every country in the world exports goods and imports from certain other countries. Therefore, the exports and imports of goods and services across different countries is defined as international trade. International trade can be briefly defined as international trade is based on international specialization, which is based on principle of comparative cost advantage. A country specializes in the production of the good which can be produced and sold at competitive marketing strategy. International trade facilitates export of goods to rest of the world at a price which is higher as compared to the one in the domestic market. International trade facilitates import of goods at a price lower than in the domestic market. These are the gains of international trade. International trade enhances opportunities of investment for the trading partners. Higher investment leads to higher GDP growth. It serves as an engine of growth. Importance of foreign trade. Number 1, increase in demand. Because of export, the demand of other things increase. Competition takes place between domestic and exports industries. With this, other industries also develop in the country. Second, supply of capital. In developing countries like India, imports are more in comparison to exports. Their investment is more in comparison of savings. It results into supply of foreign capital. Third point, development through imports. There are no sufficient resources in developing countries. For instance, natural resources, technical knowledge, etc. They are imported from foreign countries. It has a good impact on the economic development. Fourth, expansion of market. With the increase of demand in foreign countries, the market of goods in the country gets expanded. This leads to savings at a large scale. This has a remarkable impact on different industries. Fifth point, knowledge of foreign technology. Developing countries can import foreign technology because of foreign trade. This increases the production. Sixth point, optimum use of resources. Optimum use of resources is done because of the foreign trade. Consequently, the real income is increased and the capacity to save increases. Seventh point, industrialization. The developing countries supply raw materials to the developed countries. The developed countries provide capital goods like machinery, etc. to the developing countries. As a result, developing countries are moving towards industrialization. Eighth point, importance in natural crisis. In case of natural crisis like famine, earthquake, floods, etc., food grains and other necessary goods can be imported from the foreign countries. Ninth point, increase in investment. Plans play a significant role in India. More investments are required for different projects. There is not any scarcity of investment because of foreign trade. The need of investment is fulfilled with the internal and external resources. And lastly, higher economic growth rate. The economic growth rate can be increased through the foreign trade. The goods that are surplus in the country are exported. It helps in the promotion of capital formation and economic development. India's foreign trade at the time of independence. India has been an important trading nation since ancient times. The restrictive policies of commodity production, trade, and tariff pursued by the colonial government adversely affected the structure, composition, and volume of India's foreign trade. India became an exporter of primary products such as raw silk, wool, cotton, jute, indigo, etc., and an importer of finished consumer goods like silk and woolen cloths. Britain maintained a monopoly control over India's exports and imports. The composition of exports and imports of Indian economy made it backward and stagnant. More than half of India's foreign trade was restricted to Britain, while the rest was allowed with a few other countries like China, Ceylon, and Persia. Huge export surplus was used to make payments for the expenses incurred by the colonial government in Britain. This led to the drain of Indian wealth. Composition of foreign trade. The composition of trade refers to the types of goods and services we export and import. There was decline in percentage share of agricultural exports. It was because, firstly, India started using its farm product as raw materials for production. Secondly, demand for domestically produced goods increased. There was decline in percentage share of exports of conventional items like jute, tea, minerals, etc. After independence, domestic demand of these goods went up because of unplanned development programs. There was increase in percentage share of exports of machine made goods. It was to prove that development programs initiated by government were in the right direction. Volume of foreign trade. It refers to quantum of export and import of a country. From first plan, that is from 1951-52 to seventh plan, that is 1989 to 1990, the volume of foreign trade increased by 39 times, imports rose by 40 times, and exports by 39 times. The volume of trade increased 2756 times from the beginning of first plan 1951-52 to 2016-17 in 12th plan. Imports rose by 2896 times and exports by 2583 times. In this way, imports and exports both have increased but at slow rate. In 2017-18 than that of previous year 2016-17. In this way, total imports were more than that of exports till 1990 and after the introduction of new economic policy in 1991 also. Direction of foreign trade. Direction of foreign trade underwent a significant change. There was rise in number of countries we were dealing with. Direction of trade refers to the countries to which a country exports its goods and services and the countries from which it imports. There was a change in direction of exports. The bulk of India's exports were with England, America, and Commonwealth countries before 1951. But at present, we deal with almost all the countries like Australia, America, New Zealand, Japan, countries of European Union, etc. There was a substantial change in import trade too. At the time of independence, we used to import from UK and America. Since 1951, direction of India's foreign trade has also undergone a substantial change. In the wake of globalization and free trade, Chinese goods have dominated the Indian markets much more than the Indian goods in the Chinese markets. Consequently, our imports from China have risen much more than our exports to China. China has succeeded more than India in harnessing the gains of international trade. Inward looking trade strategy or import substitution strategy. Inward looking trade strategy refer to the policy of reliance on import substitution and protection to the domestic industry through import restrictions and import duties in the area of international trade. Import substitution implies domestic production of those goods which the economy has been importing from rest of the world. This is a strategy to save foreign exchange by restructuring the volume of imports. Foreign exchange, being extremely scarce, was to be utilized for the developmental imports, referring to import of such plant and machinery which is essential for growth and development but cannot be produced domestically, owing to the lack of technology or the lack of investment funds. By adopting inward-looking trade strategy, the government preferred to economize the use of foreign exchange through import substitution rather than maximize the generation of foreign exchange through export promotion. The government wanted to protect the domestic industry from international competition. Types of protection. Tariffs is a duty on the imported commodity. It directly increases the price of imported commodities, thereby offering protection to the domestic producers from foreign competition. Quotas. The government fixes the quota of import of different goods from different countries. The quota is fixed keeping in view the needs of the country. Both the tariff and quota restrict the imports and thereby protect the domestic producers from foreign competition. Positive impact of inward-looking trade strategy on Indian economy. Rise in industry's share of GDP. The proportion of GDP contributed by the industrial sector increased in the period from 11.8% in 1950-51 to 24.6% in 1990-91. The rise in the industry's share of GDP is an important indicator of development. Diversification of industrial sector. The industrial sector became well diversified by 1990, largely due to the public sector was accorded high priority in the process of industrialization. Variety of goods were produced. The production was not confined to only basic goods, which was due to the policy of protection. Promotion of small scale industries. The promotion of small scale industries gave opportunities to those people who did not have the capital to start large firms to get into business. This encouraged small investors to invest and earn returns on their investment. Small scale industries were to be developed to achieve objectives of employment, equality, and equity. Protection from foreign competition. Domestic industries were protected from foreign competition through heavy duty on imports and fixation of import quotas. It was done to promote growth of domestic industry to realize the objective of growth with self-reliance. Negative impact of inward-looking trade strategy on Indian economy. Inefficient public monopolies. The public sector made significant contribution to the growth of Indian economy. Some economists criticized the performance of many public sector enterprises as these started turning into monopolies. For example, provision of telecommunication service, as one had to wait for a long time to get a telephone connection. Lack of modernization. Because there was no competition, there was no innovation and no modernization. The policy of protection continued for a long time, still, there were no efforts spent to modernize and produce the maximum. Indigenous production could not match the international standards. Concentration of power in public sector hands. There was so much of faith invested in public sector that after 4 decades of planned development of Indian economy, no distinction was made between what the public sector alone can do, what the private sector can also do. Difficulty to close unviable government enterprises. Many public sector firms incurred huge losses but continued to function because it is difficult to close a government undertaking even if it is a drain on nation's limited resources. This does not mean that private firms are always profitable. However, a loss-making private firm will not waste resources by being kept running despite the losses.